We have seen some pretty crazy growth numbers over the last few months, and we are still seeing some pretty impressive numbers. But the Australian housing market is officially slowing down. With our biggest markets heading into extensive lockdowns, the term funding facility coming to an end, the banks increasing their interest rates, and the possibility of seeing negative interest rates, there is definitely a lot of uncertainty in our property market and our economy. So what does this mean for our property market? Is the property boom over? Hey guys, welcome back to the channel. I hope you guys are all staying safe and well during lockdown. For those that are new here, my name is Zhang and I make weekly videos on the topics of personal finance, real estate and investing. So if that's something you're interested in, definitely smash that like button right there and subscribe to the channel for more content just like this. I'm going to analyze quite a bit of information in this video, so make sure you guys watch it till the very end so you don't miss anything. And please understand that none of this is financial advice. I am not a financial advisor. I'm simply sharing with you my personal opinions and strategies. And I will always encourage you to do your own research and due diligence and seek the help of real financial experts before jumping into any big financial or investing decisions. And without further ado, let's get straight into the video. Let's start by talking about the extensive lockdown that we are currently seeing in Melbourne and Sydney, and the growing case numbers in Adelaide. Sydney has been in lockdown for a while now, and the Premier has finally announced some tough new restrictions to combat the triple-digit case numbers. At the time of filming, Melbourne is also in a lockdown, and I expect this lockdown to be quite extensive as well because of the growing case numbers. So how will this affect the property market going forward? Well, there are a few different ways to look at this. Whenever we enter into an extensive lockdown, it should decrease the level of consumer confidence. This is because whenever we go into an extensive lockdown, a lot of people are going to miss out on a lot of work because not everybody can work from home. This will mean less income and more uncertainty about the future. This is also very bad for business owners who have just started to find their feet again after the extensive lockdowns of 2020. And if you have been to the city lately, then you will see that a lot has changed. A lot of the popular restaurants are no longer there, and we are seeing more and more for lease signs. And the city is just not as busy as it used to be. And if we look at what happened during the last extensive lockdown in Melbourne and how it affected the property market, we can see in this graph here provided by CoreLogic, Melbourne, which is the second biggest city in Australia, saw one of the lowest annual growth rates. This was largely due to the extensive lockdown in Melbourne. And with Sydney now in a prolonged lockdown and Melbourne likely to follow, this should have a negative effect on the housing market. Right? Well, not necessarily. Allow me to explain. Sure, extensive lockdown is going to lower consumer confidence and therefore reduce demand as people become more worried and uncertain about the future. But at the same time, when we are in an extensive lockdown, there will be fewer number of new listings being added to the market. This is because during a lockdown, real estate agents can't go appraise a property, and the vendors who are thinking about selling their properties might decide that now is not the right time to sell because of all the uncertainty. This is going to reduce the level of supply hitting the market and likely to balance out the reducing consumer demand. And if we refer to this graph here, we can see that demand has been outpacing supply for a very long time now. According to CoreLogic, there are 1.1 sales for each new property being added to the market right now. And that simply means there are more and more eager buyers missing out and waiting for more properties to come onto the market. Look, I don't want to be a bearer of bad news, but I personally do not think the extensive lockdowns will have a major effect on the housing market. So if you're hoping that these extensive lockdowns are going to lead to a correction so that you can find a bargain afterwards, you might be a bit disappointed. However, this is not all bad news by those who are frustrated by this crazy market, because based on the data that we have been collecting over the last few months, the property market is definitely slowing down. Looking at the month-on-month change in national dwelling values, we can clearly see that March was the peak, and the rate of growth has been slowly decreasing in the last few months. I personally expect the rate of growth to slow down further in the coming months as affordability constraints start to kick in, and as the consumer confidence decreases due to the extensive lockdown that we are seeing in Melbourne, Sydney, and now Adelaide. If we look at the latest data released by Ray Morgan Research, consumer confidence is already dropping in Sydney, and it could be argued that this is a direct result of the Sydney lockdowns. And if we look at this graph provided by Domain.com, it shows the level of new loan commitments for first home buyers and owner occupiers has peaked and is now starting to decrease. Even with the level of investor activity increasing, we need to understand that the main demographic that is driving the market right now are first home buyers and owner occupiers. In my previous videos, we used the average income in Melbourne and Sydney to calculate borrowing capacity and affordability. And what we found was that most buyers in Melbourne and Sydney are already maxed out. This indicates that we could see a further slowdown of growth over the next few months. Not to mention the fact that almost all of our markets are well on track to achieve 20% growth this year, which is absolutely insane. And if we keep growing at the current levels, it'll be one, very unsustainable and increase the chances of a major correction in the coming years. And two, it would also encourage the Australian government and the Reserve Bank of Australia to step in and cool the market, exactly like what we saw back in 2017 and exactly like what we saw in New Zealand. Another important factor to discuss here is the higher interest rates and how our banks are already starting to increase their long-term fixed rates. In my personal opinion, for our major banks to start increasing their interest rates in such a competitive environment, they must be pretty damn sure that we are going to see higher interest rates before 2024. The Reserve Bank of Australia has been promising that we will not see higher interest rates until at least 2024. But with the government on track to hit their employment and inflation targets a lot sooner than they originally planned, it could suggest that we can see higher interest rates. Another reason why the banks were able to provide us with such cheap interest rates and cheap credit was the term funding facility, which is also coming to an end. With the term funding facility ending, the banks can no longer get cheap credit from the government. They will now have to get their credit somewhere else, which is usually on the wholesale market, and that can be a lot more expensive. I personally believe now is the time to be more cautious. And we also need to understand that what has happened over the last 12 months is not normal, and we need to have realistic expectations going forward. Look, I know this sounds very bearish, and that is far from the case. In fact, I purchased a property in Perth last month, and I'm looking to purchase another property sometime this month. Even with the market going absolutely crazy, I still see some good opportunities. Those opportunities are, however, not in Melbourne or Sydney. Now let's talk about the major headline that everyone else in this space is talking about: negative interest rates. Negative interest rates will simply mean the banks will now charge you money to hold your money for you, or pay you absolutely zero return for leaving your money with them. During a time of high inflation, like what we are seeing now, this is going to destroy the savers, because not only are their money getting eroded away by inflation, the banks are now charging them money to hold cash. This is going to encourage every single person to invest their money, because holding on to cash is going to become an expense. Negative interest rates will also dramatically increase our borrowing capacity, and is going to reward us for having debt. Now, knowing all of that information and how obsessed with property we are as a nation, where do you think people are going to invest all of their money now?
Yes, cryptocurrency, Bitcoin to the moon.
Just kidding. Negative interest rates will add more fuel to our property boom, as people look at houses and properties as a safe way to park their money and get a rental return, as well as capital growth. Look, I know negative interest rates sounds like a crazy concept, but the fact is, we have already seen negative interest rates in other developed countries, such as Japan and Switzerland. While negative interest rates has not worked well in Japan, it has definitely worked in Switzerland. Since 2015, the Swiss National Bank has maintained interest rates at negative 0.75%. The Swiss National Bank has had its fair share of criticism, with the position of savers and pension funds worsening as a result of very low returns. But some are saying the policy has worked, with a sharp increase in property investment, for example, as savers look for ways to increase their returns. And as we can see from this graph provided by Trading Economics, house prices in Switzerland has been growing at a very steady pace over the last 10 years. As a property owner, negative interest rates will definitely benefit me. But we need to be realistic. Just how likely are we to see negative interest rates in Australia? And should we buy an investment property in anticipation for negative interest rates? The news headline that is getting everyone's attention is this one here, where APRA has asked Australian banks to have a plan in place for negative interest rates. According to this article by Savings.com, APRA expects our banks to, at minimum, develop tactical solutions to implement zero and negative market interest rates and cash rates by the 30th of April 2022. The Reserve Bank of Australia has maintained that negative interest rates is highly unlikely in Australia, and this opinion is shared by many experts in Australia and from around the world. Personally, I don't think it's impossible to see negative interest rates in Australia, but it is very unlikely, and I will not be making any investment decisions in anticipation for negative interest rates. However, my personal opinion is that our economy, our property market, and our stock market are a lot more fragile than the government and the central banks are telling us. The stock market, the cryptocurrency market, and other asset classes all around the world have been very volatile as of lately, combined with the rising tension between China and the US. The increasing social unrest due to income and wealth equality, which is a very big problem in the US right now, it could be argued that the global economy is very fragile. It wouldn't take a lot to crash the global stock markets, and if these stock markets do crash, we could very well see governments implement negative interest rates to try to get the economy going again. Again, this scenario is very unlikely, and my personal strategy has always been to prepare for higher interest rates so that I can thrive when we see negative interest rates, if we see negative interest rates. Let's now talk about the Australian property boom. With so much uncertainty going forward and the federal election right around the corner, is the property boom coming to an end? I personally do not think so. In fact, I actually expect my portfolio to keep growing in the coming years, and I'm still adding to my portfolio. The market is definitely becoming a bit crazy, and I would love to see the crazy, unsustainable conditions cool down a bit. And I believe as affordability constraints start to kick in for our major cities, and the extensive lockdown that we're currently seeing in Melbourne, Sydney, and Adelaide, this should help cool the market a bit. We have talked about this in my previous videos, but even with the market going absolutely crazy, I still see a lot of opportunities in some of our markets, such as Perth, Adelaide, Brisbane, some regional markets, and Tasmania. If you follow me on Instagram, then you will know that I purchased my 9th investment property just a few weeks ago. To me, the numbers in Perth just make more sense than Melbourne and Sydney right now. But I want to hear your opinion. Let me know in the comment section below, which markets do you think will outperform in the coming years? And do you think we will see negative interest rates? Alright guys, I want to thank you guys for watching this video to the very end, and apologize for not making as much content as I used to. I've just been super busy lately with work, study, and this lockdown stuff. But I'll be making a lot more content for you guys now, and I've got some huge announcements coming up. So make sure you follow me on my Instagram at InvestWithZeng to stay up to date. Stay safe out there, and I'll see all of you guys in the next video.